get into the numbers because, you know, as you said, I'm a little bit of a numbers nerd. And that's why I enjoy commercial real estate like you. I started off in residential, kind of getting my feet wet, understanding real estate, learning the key players here in Huntsville. But now it's time for me to get my expensive pen. It's time for me to start my CCIM training.
Yes.
So when we talk about how to help our clients evaluate if this is the proper technique, strategy, property for them, we get into numbers, cap rates, and internal rate of return. Can you talk about the difference in between those two?
Well, I'll give you my personal perspective. So I don't claim this to be true or accurate, but the way I view it is a cap rate is really a measure of value as if you took a picture.
Okay.
So that split second in time, that's what that property is worth.
On that day,
Yes.
this is what the property's worth.
Now tomorrow, if the building goes vacant, or tomorrow your taxes escalate, or if you have a variable rate mortgage and your interest rate increases, then that snapshot is no longer valid.
Gotcha.
You have to take a new snapshot for those new variables that
Gotcha.
changed. So I prefer looking at the internal rate of return, which, by the way, you mentioned the PIN, so the CCIM will help teach all of these methodologies to us. So I look at what does it cost to get into the game, what does it cost to maintain that for a period of time, typically 5 years, and then what does it cost to get out of the game?
Okay.
So all the ebbs and flows of the income stream, the vacancies, the operating expenses.
I love it. The exit strategy. People
Yes.
don't think about the exit strategy. That's
Yeah.
important to think about when you're buying the property, not when it's time to sell it.
Well, Charlie Grillier at my office, he always talks about you make your money the day you buy. But you buy it right, that's where your profit is
heard
made.
that, yeah.
And so if you take that same concept and lead your clients into that, so you can help them if it's a 10 cap property, they don't need to be spending an 8 cap money to buy that.
Okay.
So they need to make sure that you can structure a transaction so that they're making their profit day one, and then help them maintain it, and then when they sell it at some point in the future, then it all kind of makes sense.
Right, okay.
And you can measure that with the internal rate of return
Okay.
over that long period of time. So that takes into account all the fluctuations throughout that 5 to 10 year holding period.
Okay. And then we talked a little bit about actual pro forma, and
In
actual
play.
and pro forma. I can never say it.
I refer to that actual as the in-place income. So we've already got a tenant in there, and it's currently generating income. So that's in-place income. If it's vacant, then we have to look into a crystal ball
Gotcha.
and create a fictitious market-driven pro forma income.
Pro forma.
I really don't know of any investor that's ever purchased a property on the pro forma income, because you don't know that that's going to happen.
It's imaginary.
And that's all you have to go by, then you've got to calculate, well, what kind of risk is associated? What if I don't hit that targeted income stream? How long is it going to take me to get there? And what is that going to cost me during that holding period? Or if you buy a multi-tenant shopping center and it has 15 tenants, that tenant is going to be vacant in 3 months. How long is it going to take me to fill up that slot? Will it be 9 to 12 months? And what is that holding period? And on a lot of commercial properties, the tenants pay their pro rata share of the operating expenses. Well, if that's vacant, that means the owner now has to absorb that cost as well.
Wow.
So not only is the loss of opportunity and income, but now you've added expenses here that was normally recaptured from the tenant.
I didn't think about that part.
So you calculate all that in, and then you figure some level of risk, and you can discount what you would be willing to buy it on a pro forma based on those risk factors that you've tried to look into the future to predict.
Wow.